So just tell us about the decision to lift the rating to a B plus from a B. What is the significance of that?
Okay, well, I'd say if we look at the history, basically there were elections at the end of 2007, and then it was a very close election, and it was generally viewed that the election that Odinga really won, but it wasn't entirely clear, and violence broke out all across the country in 2008. So that led to S&P downgrading it from B plus to the B negative level. And since then, there's been a number of steps where the political situation has improved. Right. And I think the latest along this chain was the promulgation of the new constitution in August. And I think it's very significant in two ways. Number one, that the politicians from diverse sections of society and with different ethnic support came together to finalize the final draft. And number two, that they put it to a referendum, and it was a peaceful referendum, no problems in the Rift Valley, and with a very large voter turnout. Almost 2/3 of the population accepted this constitution. So the constitution also has given much more clarity on the division of power between the president, parliament, and the judiciary, etc. So I think it's a solid document, and it's really will reduce political risk going ahead.
All right, and obviously the Constitution does set out a new statutory framework in terms of how the economy works. When you change a rating from a simple B to a B plus, we're told to be a little cautious because it's still 4 notches down from investment grade. So why is this something to be excited about?
Well, I mean, a ratings upgrade is always good for a country. It's an opinion, but generally it should feed into the market that their funding costs should go down. They were thinking about issuing a bond. So this will help the perception in the market that when they issue the bond, it'll be cheaper than it was before. It's a signal that things have improved. But yes, I mean it's not investment grade, but there are very few investment grade credits in Africa. But having said that, there's been a progression, and things are getting better. But I think it's a sign that Kenya's improving, and the cost of funding will go down.
Now, what is it that foreign investors would be looking for in terms of, for them, a grading that leads to clarity as to the state of this economy?
Well, I think it's quite similar to what we were looking for. I mean, there was a huge collapse in investor confidence. Over 1,300 people were killed in early 2008. Tribal issues flared up. There's a lot of ethnic tension in Kenya. And there was a collapse in investor confidence. There was a collapse in tourist numbers. And on the back of the global recession and a couple of droughts, growth was severely hampered. And I think now we're seeing, that phase has passed, right? The political situation is better, and also we're seeing a rebound of the economy. They've had good rains this year. Tourism numbers have picked up. No doubt tourism will be helped by the fact that Prince William proposed to his girlfriend at the foot of Mount Kenya. And I think things are looking up for the economy. So we're all looking at the same things, really. Okay,
Kwebi, your views here. I mean, effectively, this grading puts Kenya at par with countries like the Ukraine and Paraguay, countries within this nexus of emerging markets. Ravi referred to the political situation as a core indicator, but also issues around growth, issues around productivity in the economy. What else should be considered as criteria?
Well, I think the important thing for me here is that this is Africa emerging. And this is a great story around a country which has kind of put a process together, a political process. On the back end of that, they've had some affirmation that the process has worked. And on the back end of that, they're going to be able to go into the bond market, and they're going to be able to go and raise capital. And I think for me, that is the good news story as far as is concerned. The important criteria for me is how does follow through happen as far as is concerned. Because once you've gone and raised the capital, once you're now trying to put it down into infrastructure in your economy, and you're trying to spur growth on as far as that's concerned? What is the governance structures, and do you continue to deliver on the back end of that? Because as you continue to do that, invariably that'll lead to better credit ratings. And as you get better credit ratings, then you're able to go and your cost of debt obviously continue to come down. Those are important factors for Africa.
Okay, Kwebi's leading us into an area that I think you've alluded to earlier on, the cost of capital, fundraising, especially for infrastructure, because the government has been quite aggressive, especially in the domestic market, in terms of borrowing for infrastructure. They're trying to go internationally, and there are issues that investors would be looking at in terms of buying into government securities. Is the debt to GDP ratio, for instance, and the extent to which the government can service those debts. The government says it wants to reduce borrowing by about 10% next year. Is that feasible?
Well, I think number one, Kenya's main strength is that it has a very deep domestic debt market, and it's for this rating level, you know, it really stands out. It's able to, it's issued over 20-year bonds, and it has a very active domestic debt market. And you know, that's really something impressive. Part of it is because it was kind of shunned by the donors, and it didn't get HIPC debt relief in the past. So it was kind of forced to expand its domestic debt market. But the result is that the numbers look good, because even though its debt levels are quite high, you know, external debt numbers are not very high. They're around 26% of GDP. And the rest is borrowed domestically. So I think going ahead now, you know, I think they should be able, I don't know, probably not to the extent that they want, but they should be able to cut their cost of borrowing.
Some who've looked at this rating have raised a limitation, and they say that although Kenya is an economy that's worth over 34 billion US dollars, it still has some constraints. And they say that there's low economic development. And I suppose we can have a conversation as to what's meant by economic development, but there is a sense that the economy could be more productive, the economy could be growing at a higher rate, but it isn't because of the infrastructure constraints and because of structural imbalances within this economy. Have you factored those in?
Yes, absolutely. I think you know, number one, low economic development is a problem all across Africa. It's really what we're saying is that GDP per capita is quite low, but that, I mean, these are poor countries, so that's just a fact. But indeed, Kenya has problems. You know, it's not quite been growing as fast as several other African countries. For example, Mozambique has been growing rapidly on the back of mega projects and other growth. And Kenya doesn't really have a solid resource base in terms of, you know, it's not an oil economy, right? But on the flip side, its exports are quite diversified. You know, there's tea, coffee, tourism across the board. But I think it has to work through these infrastructure constraints and invest prudently. And then it'll get the higher levels of growth. And on the back of that, it really has to maintain political stability going ahead.
I mean, Kwebi, here we are talking about sovereign debt crises in Southern Europe and some of the smaller European countries. And these are essentially economies, along with others in the emerging market, that will be competing with Kenya, for instance, in terms of attracting capital for government bonds. We've also heard of Nigeria planning to launch a huge sovereign bond over 500 billion US dollars, and Kenya enters this fray. What's going to make Kenya stand distinctly above the rest?
Well, remember, as they enter the bond market, the one thing that they have to compensate investors for the risk that they're assuming is the higher yield. And obviously you're not getting those kind of yields on your old world bonds, which is the kind of Western type bonds with higher gradings and ratings, obviously. The question is, and one has to, from an investment perspective, so it's not necessarily a rating issue, but from an investment perspective, one has to consider that from a social perspective, there's major shifts in the Western world that's busy happening. And those aren't necessarily going to stop for the next 2 decades. Whereas if you look at the emergent world, it's literally just trying to enter itself into an industrial phase, and it's trying to live within an industrial phase where there is potentially going to be new clients in the future. And the question really for me is, how do you utilize that capital in order to fast track growth and continue just to say to investors, here we are, we're open for business, we're going to follow a governance process, and we're going to become better at what we're doing, and we're about making money.
Right.
And I think that's an African story.